Financial literacy is the ability to understand how money works in the world and make informed decisions with financial resources. Lack of financial knowledge can lead to poor financial decisions and planning. Financial education helps inform consumers. Financial literacy also involves knowledge about insurance, retirement, investments, and real estate to make educated choices. Rule 1, pay for what you need first, then buy what you want if you can afford it. Understand the difference between needs and wants. Rule 2, write a monthly budget and stick to it. Track your income and expenses, including essentials and planned expenditures.
Enter the money you receive, like your salary, then deduct for rent, tuition, groceries, and bills. Tithes should also be a part of your budget. Only use credit to buy things that will last longer than it takes to pay them off. Ensure your budget reflects what you can truly afford. Debt can be a useful tool to achieve your goals, like buying a house. Manage it carefully for it to become your friend. Good debt, like a mortgage, can appreciate over time, while bad debt can lead to unnecessary problems. Try to save a little money every month. The feeling of saving and having money when needed is incredible.
If you get letters from creditors, open them and read them. You must know where you stand with each creditor. Discuss your financial situation with your family. Everyone must cooperate to get out of debt, and sacrifices will be necessary. If you have credit cards, cut them up and throw them away immediately. Budget monthly to identify surplus and cut spending. Even small payments help reduce debt interest. List all creditors and their amounts. Make paying them off a goal while leaving enough to live on. Contact the accounts departments of creditors and request a smaller monthly payment. Get any agreements in writing. Until your debts are cleared, avoid buying anything else on credit. Encourage your family to cut unnecessary expenses.
Your biggest loan may not cost the most. Look at the interest rate you're paying, not how much you owe. For most people, credit cards are a good place to start. Store credit cards often charge 20% or more in interest. If you owe P1000, you could pay as much as P200 in interest in the first year. Consider a consolidation loan to lower overall interest rates. This strategy works only if you don't rack up more debt. Set up automatic withdrawals to avoid spending extra money. This helps you allocate funds directly to debt repayment. Many mortgage lenders allow extra payments against the principal. Paying down your mortgage can reduce overall loan costs over time. Be cautious of organizations claiming to help clear your debt for a fee. Do your research before engaging with them. Ask for credentials of financial planners or debt counselors. Always check if they are registered and qualified.
Consolidating Assist can help you save money by reducing the overall interest paid on debts. If possible, transfer the most expensive debt to a debt with a lower interest rate. In certain situations, it may be necessary to liquidate investments to pay off debts. This is where a financial planner can play an important role in navigating your options. Sell non-essential assets and use the proceeds to pay off debts. If possible, pay any additional amounts of money received into your mortgage bond.